Don't know how to ace your investing journey? Well, there's certainly no need to worry, as we're here to provide you insights on the many options you have for the same. One of such options is mutual funds. And before we even start, the only question that comes to mind is, क्या mutual funds सही हैं? Mutual fund investments are subject to market risk. Please read all scheme-related documents carefully before investing. Sounds familiar, doesn't it? Yes, there certainly are some associated risks with mutual funds. But before getting into that, let's understand what mutual funds are in the first place. In simple terms, mutual means common and fund means money. The term mutual fund suggests a group of people pooling in their money together, which is then invested in various instruments such as stocks, bonds, gold, etc., according to the common goal of the fund. The fund manager is the one who manages the pool of money in line with the common goal. This definition, seemingly daunting at first, is nothing different than a simple gifting problem. You want to create a gift basket with a variety of things, but you don't know what to purchase. So you ask your friend who knows more about the same, and that helps you get the perfect gift basket. Mutual funds are the similar basket of investments handled by your friend, who in this case is your fund manager. Mutual funds, while a concise concept, has many underlying classifications and options that one can consider. After all, choices provide optimal selection, don't they? The classifications can be according to constitutions, objectives, and under these divisions we have a vast pool of options that we shall delve into. Are you a risk taker or do you prefer playing it safe? This is a question that is important for all classifications of mutual fund schemes. Your risk profile determines whether your mutual fund portfolio involves low, moderate or high risk. Assessing your risk taking ability and knowing your goal for investment are the main ingredients for making the right choice. If you're not sure of your risk profile, you can check it on our website. The link to risk tolerance calculator is in the description. These risks are administered by the asset class selections that your fund manager will help you select. The funds according to asset classes can be classified into only debt, only equity, commodity. Furthermore, any intersection between these three fall under the hybrid funds. Only debt funds are the ones that invest in bonds and other securities which are relatively safer and provide periodic dividends. Contrary to the common notion that a debt is a long-term loan, debt funds are available for periods ranging from a day to 7+ years. On the other hand, only equity funds, also commonly known as stock funds, enable an investor to have holdings in multiple companies under one fund instead of holding individual stocks in each. We like the complexities of the stock market, don't we? Equity funds provide exactly that through the various options available on the basis of purpose, market capitalization, themes or sectors, overseas exposure and diversification. For investors oriented towards purposes such as tax saving and investment in top-tier companies, ELSS and blue chip funds are the way to go. ELSS, meaning equity-linked saving schemes, provide options in the equity market with a mandatory lock-in period of 3 years. Under the Section 80 CEE of Income Tax Act, these funds allow to deduct your taxable income up to 1.5 lakhs. While blue chip funds deal with the big players in the market, the companies with a stable performance and a loyal customer base. Now comes the classification on the basis of market capitalization. This is nothing else but a measure of the size of the companies which can be classified into large cap, small cap and mid cap. In simpler terms, good middle cap companies and small cap companies are like the underdogs of the stock market, prone to higher fluctuations, while the good large cap companies are the known stars expected to perform well. Classification on the basis of themes and sectors, as the name suggests, direct the fund towards a particular field of production or for a particular cause. While thematic and sectoral funds sound very similar, they have some faint differences. Some of us are keen followers of the automobile sector, while others might have their affinity to the pharmaceutical sector. This is what sectoral funds are about. Thematic funds, on the other hand, invest in accordance to an underlying scheme. These may be social, governance, and environmental themes across varying sectors. The Make in India program, for instance, is a theme according to which investors might be motivated to divert funds to Indian companies in any sectors. Speaking of themes and investor interests, we all know of the famous FANG, don't we? Such international stocks have always been the hotspots of investor interest, and overseas funds provide us the platform to invest in these. These not only enhance diversification but also mitigate risk through considering fluctuations outside the Indian economy as well. Now that we know of all these options, another thing to note is that these options are present as combinations of various classifications. For instance, the Aditya Birla PSU Equity Fund is a thematic equity fund that invests in public sector enterprises across various sectors such as banking and power. Similarly, we have the ICICI Prudential Fund, which is a combination of small cap and equity funds. There are many other examples available. Let us look at these classifications again through a simple diagram for better understanding. Once we are well equipped with the different types of funds, all we need is a good guide who can provide us with this optimal basket of investments. A key factor to note before investing in mutual funds is the cost you pay for the same. After all, everyone wants to succeed in their financial endeavors at the lowest cost possible. The expense ratio is what tells you about this cost as the annual charge levied by mutual funds. This is an important indicator to consider before investing. Ideally, a good expense ratio is around 1%, but it is also essential to consider the size of the mutual fund you are investing in. Mutual funds are a comprehensive scheme, and you can certainly use them as an investment option. All that you need to do is assess yourself and the fund through the parameters mentioned. Don't rush in picking the funds, think first. Invest, don't speculate. And the most common of them all, don't put all your eggs in one basket. One needs to be aware of the choice of funds and the kind of portfolio they want. Once you know all that is required in the understanding of mutual funds, just remember that mutual fund sahi hai ki nahi wo aap par hai.